Welcome to IT Audit Webinar Training via Practical Application, presented jointly by AuditNet and Richard Cascarino and Associates. This webinar is part of the Training Without Travel series covering IT Audit. Today's webinar covers risk analysis for auditors. This is part of the Advanced IT Audit webinar series. My name is Jim Kaplan, founder and owner of AuditNet, and I'll be moderating today's webinar. Joining us is Richard Cascarino, principal of Richard Cascarino and Associates, who will cover this webinar. Let me have Richard introduce himself and give you a brief overview of his background, and then I'll cover the housekeeping items for today's webinar. Richard?
Thanks, Jim. As Jim said, my name is Richard Cascarino. For those of you who were with us on the first series, the 5 webinar series, I apologize you're having to listen to this again. For those who are new, welcome. I'm a principal of Richard Cascarino and Associates based out of Steamboat Springs in Colorado and in Johannesburg in South Africa. I'm currently broadcasting to you from South Africa. My background, I have a depressing number of years experience in IT audit, IT audit training, and consultancy. I am a past president of the Institute of Internal Auditors in South Africa, a member of ISACA, and a member of the Association of Certified Fraud Examiners. I've written 3 books. I'm halfway through my 4th one. Probably the most appropriate one for this course is The Auditor's Guide to IT Auditing. I'm going to hand you back to Jim so that he can take you through some of the housekeeping for this webinar.
Thank you, Richard. Well, we sent the slides out to everyone this morning, so you should have these slides, and I'm not going to bore you by reading from them, but I just want to remind you that we are recording today's webinar, and you will get a link to the recording. We should be sending that out by tomorrow or by Thursday. We also have an evaluation at the end of the webinar. Please fill out that evaluation to help us continuously improve the webinars series. Because today's session qualifies for NASBA CPE, we are required to ask polling questions. You must answer the polling questions. If you're joining us from a mobile device today, you may not be able to answer the questions or respond to them, in which case just accumulate all of your answers into a single email and send them to us, and we'll record your answers in our records. You do have the ability to ask questions, so please submit your questions via the chat box on your screen. We'll answer them usually at the time that we break for polling questions. The next slide provides you with our disclaimer, and again, that was sent out in this morning's distribution, so I'm not going to read the disclaimer. I want to provide the maximum amount of time for Richard for today's webinar on risk analysis for auditors. Richard?
Thanks, Jim. Okay, what are we going to cover today? Well, we're going to have a look at risk and risk analysis. And what I'm going to do is give you some exposure to 2 or 3 different ways of looking at risk and evaluating risk in an IT framework. So we'll kick off by having a look at what is risk and what is the nature of risk and the definitions, because various organizations have got various definitions of what risk actually is. We'll have a look at internal risk assessment, a framework for doing that, and we'll take a look at risk-based auditing, which an integrated approach to looking at it within IT systems. We're going to have a look at some risks in financial services, because many of your customers and many of the people on the webinar are from financial services. We'll also have a look at computer risks and in specific fraud. We'll take a look at how you go about reducing the risks in electronic interchanges. Unfortunately, you cannot eliminate the risk. The only way you can eliminate computer risk is take a sledgehammer and put it through the computer. And now you have to worry about pen and pencil risk. But as long as we have people legitimately entitled to put things in and take things out, they're going to do it when they're not supposed to. and other people are going to try and do it as well. We'll have a look at the IT risk-based audit approach and prioritization of our audit programs based on IT risk. We'll take a look at risk materiality, structuring the risk approach, implementing the approach, and ultimately selling management on risk. It's something that we always tend to forget, both as auditors and as consultants. Anything we come up with, we need somebody else to implement. So we need to sell what we have found. And in many cases, it involves selling people on either changing the way they're doing things or spending money that they'd rather not spend. So there needs to be a benefit, a payback for them. And we need to get that message across. So, what is risk? At the end of the day, it doesn't matter if you're a company or an individual, if you're an industry or a country. All entities encounter risk, regardless of whether they're the market leader, the biggest in the industry, a newcomer to the industry, regardless of whether they are dispersed geographically across the world or if they're centralized in one spot, regardless of the nature of the business or the industry they're involved in. And within each individual entity, there's a variety of risk elements that kick in. All business decisions involve some element of risk. Number one, the money. Where is the money going to come from? Can we afford it? Are we bringing in more than we're putting out? What are our product lines? Should we introduce a new product line? Should we eliminate a product line we've already got? Which are our cash cows and which are our loss leaders? Where are we going to get our supply? Now that could be a supply of raw materials, it could be a supply of talent, it could be a supply of training. If we're going to go for training, do we have to have face-to-face training? Do we go for webinar-based training? Do you go for computer-based training? If we're talking about people, do you make them? Do you train them yourself, or do you go out and recruit the people? Do you hire them temporarily and bring in consultants? All of these involve a decision involving risk. So if we decide that we're going to bring in an expert, and that expert is not all that expert, we're in trouble. If we decide that we're going to develop our own people, and we can't develop them fast enough or far enough, we're in trouble. So every decision involves some form of risk. And all of these have to be assessed at the entity level by the chief executive and then related to whatever business activity the organization is involved in. Now, why do we need to worry? Because at the end of the day, we worry not about what the sources of the risk are, but what the effects of the risk are. Worst case scenario, you have a risk, you cannot cover it, you're going to go out of business. In a human terms, you can be faced with a risk that would affect your ability to survive. When I'm running a face-to-face course, I usually ask people at this point, what do you reckon the biggest risk that your organization faces? And we get things like fraud, and we get things like loss of customers. So then I'll ask, what do you reckon is the primary objective of your business? And most people will tell me things like, to make money, to make profits. The number one essential thing for any business is to stay in business. If you're not making money, you want to stay in business in the hope that in the future you will make money. So anything that affects the organization's ability to survive is your number one risk. And that could be loss of reputation. We had a classic case on the television yesterday regarding Thomas Cook, the travel company. There was an unfortunate accident, problem about 3 years ago, 4 years ago, where 2 children died in a hotel room. And it was a hotel room booked by Thomas Cook. And it turned out it was a problem with carbon monoxide poisoning in the heating system. The children died. The hotel paid them compensation of $350,000. It came out yesterday that Thomas Cook had been awarded £3.5 million, and all hell was let loose. So regardless of what happened with the money, the impact on Thomas Cook of that loss of reputation, the reputation that they care for their customers, has hit them and hit them hard. Yesterday they announced that they were going to give $1.5 million to charity. The immediate reaction from the media was too little, too late. So it doesn't necessarily need to be a computer collapse. It could be something as simple as one of your customers needs to get money out of an ATM and the ATM is offline. If that is for an extended period, that could put you out of business. In order to survive, typically you have to do a whole pile of smaller things. You've got to be able to successfully compete. You've got to maintain financial strength. Even if you're not running at a profit, if you run at too big a loss for too long, you're going to go out of business. You've got to maintain a positive public image. And all of that is affected by the overall quality of the products that are being produced, of the services that are being delivered, of the people who are doing the delivering. And at the end of the day, as long as you want to stay in business, you cannot eliminate risk. Risk is not a bad thing. Risk is good. Risk is where you make your profits. But we need to manage the risk. And we can only manage the risk if we know what the risks are that we face. So we start off by looking at the whole organization, or if you're consulting to one part or auditing one part, we might look at all of that particular entity within the organization. And we want to do an entity-wide risk identification. And that largely depends on what they're trying to achieve. Okay, so when we talk about, for example, the payroll section, I use payroll as an example because every company runs a payroll. Okay, what is the objective of the payroll? Is to pay people. Great. Which people? Our employees, at the right rate, at the right time, in the right place, at the going amount. And all of these become control objectives that need to be achieved in order to achieve the business objective, which is to pay people. Now, if that's what we're trying to achieve, what is a risk? Anything that can stop us achieving those control objectives. So we could pay the wrong people at the wrong rate, in the wrong place at the wrong time. So when we look at risk-wide identification, you have to start with what are you trying to achieve? What can stop you achieving it? And it's an iterative process. It's not a do it once and we're finished. Because the business is changing, the risks are changing. Now, some organizations do it as part of their planning process and do it in a zero base. So every year we start by saying, okay, let's assume, what are we trying to achieve? What could go wrong? Others look on it as incremental to the last time we reviewed this thing. And the risks themselves can either be internal risks, which we can control totally ourselves, or arising from external factors. Government decides to bring in new regulation. You might wish it didn't, but it has. Tough. Now the organization has to cope with those new regulations. It could be that there's new taxation coming in. It could be that there's a new competitor in the marketplace. It could be that technology has changed and therefore the product that you're actually selling has changed. If we look at banks, in the olden days, banks used to be in the business of moving pieces of paper and lumps of metal around the country and out of the customer's pocket into the bank vaults, and out of the bank vaults back to the customer's pockets. To a large extent, that's gone. What happens with a bank now is that the bank's computer is told by a customer's computer to transfer money from the customer's account to another person's account, which may not even be with that bank, by purchasing something online. The bank's computer will then tell the customer's computer, here is your money. The supplier's computer will then tell the bank's customer, here is your goods or services. And the bank's computer will remove that money from their customer's account. So it's shifted. Banks are no longer in the business of moving lumps of metal around. They're in the business of moving bits and bytes around. And that's created a whole different risk profile for financial institutions. And the factors themselves can be interrelated. Because of what the competition is doing, therefore we do something differently, which we can control, but nevertheless we are forced into certain paths. Typical internal factors that we would look at, it would include things like the quality of our people. Now that could be the quality of the people that we have employed at the time we employ them, or it could be the quality of people after they've been through our training regimen, etc. It could be the quality of people based on their motivation. If they think the company is going well, they may be highly motivated. If they think the company is going down the tubes, they may be considerably less motivated. But that's part of the internal factors that the company can do something about. The integrity of the people. Can you do anything about the integrity of your people? Well, to a certain extent you can. You cannot, once again, eliminate that risk, but we can reduce it to an acceptable level by making what an individual employee can do be limited. So if we cannot control their integrity, we can at least reduce the impact if the integrity fails. Other internal factors include things like changes in management's responsibility. If you take an expert manager and put them into an area that they don't know anything about, your quality of the management is going to go down. Span of control. How much do they control? The degree of dependence on the information systems and the stability of those systems can be a key internal factor. If those systems are not available, can you survive? If not, that's going to be one of your number one risks. Never mind fraud. If your systems are down, will you survive? And that could be down for long term, or it could be simply the stability that they're forever going up and down, up and down, up and down. Accessibility of assets and liquidity of assets are internal factors. We can control the accessibility. The effectiveness of the board and the audit committee of the board, again, an internal factor directly under control. External factors, those factors which we cannot control, but nevertheless we can respond to, include our competition, new regulations and changes to regulations, political changes. If your source of raw materials is somewhere in the Middle East and ISIS starts a war in that area, now you can argue whether they start it or whether they continue it, but if a war goes on in that area, all of a sudden your raw materials have dried up because of political changes. Economic changes for the better or for the worse. If the economy starts to boom, It's a risk factor that you will not be the organization in place to take advantage of that boom. If the economy goes down, can you survive it? Technological development. And of course, unfortunately, natural catastrophes. So, if those are all of the external factors, not all of them, but some of them, how then do we identify risks? A lot of the risk evaluation techniques that are used within industry have been developed either by their external auditors or by their internal auditors because they cannot do their job, which is looking at the controls over risk, unless they know what the risks are. And they can involve a quantitative and a qualitative prioritization. It's not the only way. A lot of organizations use periodic reviews of economic and industrial factors or go off on senior management business planning conferences. They even bring in industry analysts. One organization I know of in the gold mining industry, they had an internal analyst with a complete department looking at the state of the economy and what was likely to happen within gold prices, gold consumption. And they called them into a business planning conference of the board, and they said, what's going to happen to gold over the next year? And the guy said, well, we've looked at what's happening with gold's use in industrial environments, and we've looked at what's happening with jewelry consumption. And they said, no, hang on. What's going to happen to the gold price? And they said, well, you know, we've looked at what Russia's doing, and we took into consideration what China's doing. What's going to happen to the gold price? And I said, well, based on all the work that we've done, we can confidently predict that over the next 12 months, the gold price will rise and fall, although not necessarily in that order. And that's the problem with some of the industry analysts. It's a forecast. It's a guess. And that, unfortunately, is what we're doing in many cases when we're looking at risks. We're saying, what's the worst case scenario if this happened, and how likely is it to happen? How we get there, the method of determining the risk, is not particularly important. The thing that is critical are the factors which contribute to the risk or which increase the risk. And that brings us to our first polling question of the night. And our first polling question in this case is an example of an external risk factor would be technological development, accessibility of assets, quality of personnel, effectiveness of the audit committee. Once again, you don't have to get the answers right, but if you want the CPE, you have to answer. We're looking for external risk factors. And remember what an external risk factor is? It's something that you do not have control over. So I'll share the results. And the majority of people went for technological development. And that's true, it's an external risk factor. Now, it might influence how you're going to respond to that. Are you going to go with the latest? Are you going to go into the cloud? Are you going to go with mobile computing? What are your customers doing with technology? And it's an external factor, but you can respond to it. The accessibility of assets, we can lock them up. Quality of personnel, you can train your people, you can employ good people. And the effectiveness of the audit committee is very much an internal factor. If your audit committee is not performing, you replace your audit committee. Okay, let us press on. So how does all this lot fit with internal audit? Well, internal audit and risk analysis, we need as auditors to use risk analysis to evaluate if it happened, how bad could it be? What is the significance of that particular risk? To assess the likelihood of it happening, or in some cases, how often it's likely to happen. And once you've come up with those, then you can say, now, I know what the impact on the organization is. These are my high risk areas. That's where I need to audit most. Now, the fact that it's high risk does not mean to say it's going to be badly controlled. All being well, if management has been doing their job properly, it will be well controlled because it is high risk. Management have been putting a lot of effort in that area. But as auditors and as consultants, we need to look at this in order to say, well, in our opinion, after discussions with management, how should that risk be managed? What actions need to be taken? What controls need to be put into place? And we can do it basically two ways. Preventative procedures to reduce the significance if a risk occurs, or the likelihood of the risk occurring. And then a displacement procedure to offset the impact if it does actually happen. Okay, and normally when we do risk, we're looking at risk from inherent risk. How risky would it be if there were no controls, or if all of the controls failed? Now, you can't really say that. And the problem with speaking to management is if you ask management, is this high risk? They'll tell you, no, it's not high risk, because we know we've got it under control. If you ask management, is this critical to the company? Oh, yes, this is the most critical thing in the company. In other words, it's high risk if those controls fail. So how do we identify the high risk areas? Usually it's done based on either business unit or function. It could be the standard ones, sales, production, marketing, whatever it happens to be. And each of those are going to have their own set of objectives, hopefully tying into the corporate objectives. And for each of those objectives, there's going to be multiple risks. Now, not every single risk can be identified. You'll never get it 100% right, but the readily apparent ones we have to consider. Management has to consider. And again, when we consider what those risks are, there are multiple ways of defining it. You'll see in different textbooks, risk is defined as the possibility of loss. Other ones will tell you risk is the probability of loss. Some of them will tell you that risk expresses a possible loss over a specified period of time. So how much is at risk per year? But that's a difficult one because that involves very much an empirical risk. Count it up. We are $3.5 million at risk per year. Well, maybe yes, maybe no, but what about loss of reputation? Can you put a value to that? So other ones will say that risk is simply the potential for realizing unwanted negative consequences. Now, that helps, but it's got to be measurable. So then we need to look at risk measuring the probability and severity of any adverse effect. And roughly, when you boil all that lot down, it simply says that risk is a function of the probability that an event will occur and the consequence if it does. And it could be that you are going to make 20% profit this year, but you could have made 35% profit. So it's not always that the risk is that something is going to go wrong. It could be a risk that something will go right, but not as right as it could have gone. Now, with all that said, how do we go about it? Well, we start off by looking at the processes, the business processes within the organization, and then looking towards the key dependencies and control nodes. That cannot work without this. And that's a point at which assets move, records transform, vulnerability exists. So we look at the processes within any particular business entity and look for cross-organizational dependencies. We look for where data originates, where it is kept, how the data, raw data, gets converted into useful information, and who uses that information. Because each of those stages faces risks. Where it originates, we may end up with the wrong data or not enough data. Some of it's missing. Where it's stored, is it kept under strong control conditions, or is it possible to corrupt it or to lose it, destroy it? If it's critical, is it possible to lose confidentiality? How does that raw data get converted to useful information? And are the people who are using it correctly? And all of those processes can be positively affected by good quality of control procedures and badly affected by poor ones. Now, typical elements that we look at within our risk analysis is cost benefit. When we are now turning around and saying, we know that the inherent risk is very high, how much is it going to cost to drop it down to an acceptable level? And it's easier to measure cost normally than it is to measure benefit. Now, in theory, we should incur costs until the costs equal the benefits. If you can spend $100 to save 120, that's great. Or to make 120, that's great. But you've got limited parcels of $100. Some of them can make 120, some of them can make 150, some of them can make 180. So we want to put our money where our bucks will give us the biggest bang. And in practice, that's a management decision, which means that although we can look at risk as a whole, and auditors do, and consultants do, and management does, cost-benefit analysis usually means that we will manage that part of the risk because we'll get a good return for that. And we'll accept that part of the risk because it's not cost-effective to try and manage it. It's not worth employing a new accountant to look after $50 worth of petty cash. Problem: what happens when that $50 of petty cash over a 2 or 3 year period builds up to $500,000? So management has to review that residual risk. How much risk are we saying we will accept on an ongoing basis from all of those exposures? From the potential for loss, from the potential for fraud, from the potential for bad publicity. Now, risk analysis, great, we can do all kinds of risk analysis. The fact that you've done it still doesn't mean we're going to get it right. Because we're still faced with the potential for poor judgment in our decision making. We know what the risks are, we've done a good risk evaluation, we've figured it all out, but we still make the wrong decision. And it can be because when we looked at the data that was available to make the decision on, it was not complete, it was not accurate, it was not up to date. We were looking at last year's predictions of market movement and based our decisions on that. And that was wrong. With the best information, assuming it is complete, it is accurate, it is timely, people make the wrong decision. They will buy when they should sell. We do it all the time. The last house that I bought right at the top of the market. When I sold it right at the bottom of the market. So I made losses. Why? Because I could not predict the market, and because I was moving from South Africa to America, so I had to sell in South Africa, and it happened to be the top of the market. in South Africa, but I had to then buy in America, which was at the top of the market, and now it's down to the bottom of the market again. People get tired and people make mistakes. So you've done all of the good risk analysis and we still get it wrong. We've put all the controls in place to circumvent the risks. But now you've got two or more people acting collectively, deliberately to circumvent the controls. So your controls are not going to be effective. You get management who say, well, that's okay. All of those controls are appropriate, but they don't really apply to me because I'm a manager. And therefore they bypass the system of internal controls with the famous unpredictable results. Nevertheless, even though we cannot be 100% sure we'll get it right, meaningful risk analysis, doing it properly, can substantially increase the probability of achieving our objectives. Where it cannot guarantee it, it can at least alert management to the areas where changes need to be made to our control procedures to pull that level of inherent risk down, to give us a residual risk, the bit that's left after our controls, and to make sure that that residual risk stays in an acceptable range for management. And that means that we can then link the activity objectives, what they're trying to achieve, and the control objectives, to what actions need to be done to implement the appropriate controls without over-controlling. In best case scenario, it becomes second nature. And it can be formally done with risk analysis and risk software, etc., or it can be informally done. It's not how formal it is, it's the impact, it's the results which are critical. And that brings us to our second polling question. Our second polling question is looking at key dependencies and control nodes and identifying those is part of cost-benefit analysis, prevention of collusion, process analysis, management review. Which of those is it a part of? I'll give it another 5 seconds. And we'll close the polls. Remember, if you cannot vote because you're using a tablet or other device, gather the answers, put them together in one email and send them through to Jim. We'll share the results, and the bulk of people went for the process analysis, which is a critical area. Okay. Let's take a look at risks within one area. I'm just going to take financial services because, as I said, it's quite a common area for people on the webinar, and it's also a common area for clients of people on the webinar. And the same kind of risks, in one way, apply in many organizations. So what do we have in financial services? We've got business units which are spread geographically across the country, possibly internationally. Now, because they are a financial institution and they fully understand the risks, hopefully, the policies and procedures are normally standard. Okay? This is how we handle applications for loans. This is how we handle mortgages. This is how we handle compliance with all of the Dodd-Frank legislation. Problem is, the policies and procedures are generally standard. The implementation is not, because you're dealing with people. So we're looking at how well in each of the business areas our policies and procedures are actually being implemented. And when financial institutions look at the risk models, they look at it in a 4 level. They look at raw risk, they look at company risk, estimated risk, and final risk. Raw risk, assuming we had no controls or assuming none of the controls functioned as intended. How bad could it be? The example I usually give is you've decided to move gold bars on a flatbed truck through the middle of town in the rush hour. What's the likelihood of them all arriving at the other end? Fairly low. In Johannesburg, the likelihood would be nil, because they would stop the truck, they would hijack it, they would throw the gold bars off because it would slow them down in their getaway, and they would go off in the truck, because nobody would believe that anyone would be stupid enough to actually put gold bars on the back of it. They would assume it was lead. But nevertheless, that's our inherent risk. So we're not going to move it in the middle of the rush hour. We'll take random routes. We will not go through the city centre. We will not use a flatbed truck. We'll put it in an armoured car. We will use armed outriders. We will introduce a whole pile of controls. And that will give us our company risk. Now that company risk is our exposure, our raw risk, mitigated by the controls, on the assumption that those controls are functioning as intended. Are they functioning as intended? Well, that's where we come up with our estimated risk. Our estimated risk is the company risk tempered by the time since it was last looked at and the results when it was last audited. If we looked at it a year ago and it was in good condition, the controls seem to be functioning as intended, and nothing has changed, not in the personnel, not in the objectives, not in the risk levels, then our estimated risk will be pretty close to the company risk. On the other hand, if we were in a year ago and it was a total disaster and nothing has changed, then our estimated risk is going to be considerably higher than the company risk and much closer to a raw risk. And ultimately, we're going to have to negotiate that with management and come up with our final risk, our final agreed on risk level. And that's one of the ways that financial institutions do it. So how do they come up with the raw risk and the weightings for those risk factors? Well, the raw risk itself is a function of the types and the amounts of the activities themselves. And there's 2 major considerations that are normally taken into consideration. What is the value of assets under control? And what are the value of assets at risk? Okay, so we know which ones are supposedly under control and which ones are not going to be covered by those controls. So it's not company policy to have armed outriders beside our armoured cars. So there's a risk in that area. Our control environmental factors are typically arrived at using the top 12 factors picked out of control deficiencies. Okay, and you can find out what these are. You can get benchmarking tests with financial institutions or whatever industry you're in. But at the end of the day, the final weights that you assign to those risk factors have to be your own company's. Okay, because only your company faces those risks in that unique way. In other companies, loans might be more significant than internet banking. In other companies, internet banking might be high. We don't have a big loan portfolio. When you're putting those weightings together within your own organization, we want to derive them from as many inputs as possible, from management, from the people running the organization, from the people doing the jobs, from other auditors. And if you end up with a valid set of weightings, you should see a bell curve in the weighting distribution. That's a normal distribution. So how do they then measure the risk? Well, what we're looking at is key attributes for each unit that we could audit. We want to calculate a risk coefficient. Now, to do that, we've got to look at the organization, or look at the part of the organization that we're examining, and split it up into auditable units. If we were looking at IT, we could say that, for example, operations is one unit. Systems development is another unit. Technical support is another unit. Communications is another unit. Or we could turn around and say, look at the company, and IT is one unit within the company. And we're going to take all of those risk factors and rank every unit against every other unit. And that means if a unit comes out low on the risk profile, it doesn't mean it's no risk, and it doesn't even mean it's low risk. It means it's low comparative risk compared to other units. And we then group them in terms of the size of the unit, the control environment of the unit, perhaps the date of the last audit, and perhaps how it was rated then. And each individual factor gets a weighting showing the relative importance to the company of that risk factor in that particular function area. Now, obviously, a business unit, let's say a branch of a bank, and a service unit, let's say your IT division, are going to have different risk factors. So we need some way of getting commonality in order to come up with those. These are typical size of unit risk factors and weightings for a bank. Okay. Now, I'm not saying this is going to be right for you. It's not going to be right for you. This is a bank. Risk factor is looking at, for example, ledger assets, commitments, contingent liabilities, fiduciary assets, non-ledger assets, expenses, income. In South Africa, it'd be rand volumes. In America, dollar volumes, loan portfolio size, transaction size, perhaps the number of employees, perhaps the growth in the unit. And then sitting with management saying, okay, for this particular financial institution, which of these are the biggest risk to us? This particular one has said number one risk is our loan portfolio size. So each of them gave a weighting. We took them, we averaged them, and came up with the weighting. Next risk after that was growth of unit. The faster the unit grows and the bigger it grows, the more likely it is to outstrip its control functions. Then they were worried about the ledger assets and commitments, contingent liabilities, etc. Then came down to the actual cash volumes. Then it dropped down to transaction size and income, and then finally the number of employees and the expenses. And those were size of unit. Okay. If we then take that and apply it looking at other types of units, service units, there your primary risk factors can include things like the extent of dependence on other units. Are you dependent on them, or are they dependent on you? How critical is this business area? Commitments, contingent liabilities, fiduciary assets, non-ledger assets, etc. Expenses and income. Rand volumes again. Criticality of service timeframes for adequate support of other units. transaction numbers and sizes, number of employees, growth of the unit. And if we look back at the previous one, you'll see we had ledger assets on size of unit. We've got the extent of dependence on other units as a measurement for a service unit. We are all the same all the way down. If we look at number 3, number 4, number 5, number 6 changed from loan portfolio size to criticality of service timeframes. These are not my service unit, these are not my factors rather, these are the factors of this particular financial institution. These are not my weightings, these are their weightings. And you can see there the two that outstrip everything else for a service unit in this particular financial institution were the extent of dependence on other units and the criticality of timescales for adequate support of other units. Those were the two major risk factors. Now that's based on size. If we look at the control environment, what factors would we take into consideration? Well, these are the top 12 that are normally looked at for a financial institution. Management and supervisory turnover. The more you turn over your managers, the worse your control environment is going to end up. Employee turnover, same principle. Management confidence. That's an interesting one. Not competence, confidence. Changes to the organization or the environment of the organization, introduction of new products and systems, geographic dispersion. There's always been that worry that out of sight equals out of mind. External economic conditions, risk ratings of portfolios, liquidity of assets, regulatory environment concerns, occurrence of fraud, and what other auditor or examiners definitions have said. My apologies, I just jumped back one by mistake. So looking at all of those, you can see the weightings that came out there. The number one weighting that they came up with was other reports and controls. Have we had problems in the past in this area with these controls? If the answer to that is yes, I'm worried. Management's confidence comes in high. Why would that be a high risk factor? Because in many cases where management is confident, management overlooks the controls. Then coming down to turnovers, etc. So all of those would be risk factors on the control environment. If we look at computer systems, these are typical computer systems factors. Size, normally measured by the length of the project, number of people involved, total project expenses, and that's the normal weighting. How expensive is this computer project going to be? That's a high risk. How big is it? And how long is it going to take? Control environment, these are common risk factors looking at the control environment for IT systems. The impact of new technology, operational and customer impact, corporate financial impact. Those are the three biggies. And then it drops down below that, typically. Produces negotiable items, checks come out, whatever. Legal and regulatory impact. And then down to the number of system interfaces and knowledge of existing control weaknesses. Remember, if you're going to use anything like this, these weightings give you a clue. But the weightings have to be for your institution or your customer's institution. Otherwise, you're not going to come up with usable risk factors. And that brings us to polling question number 3. Polling question number 3 looks at the definition of risk. And it says raw risk may be defined as exposure mitigated by control, total inherent risk, risk tempered by the time since the last audit, final agreed on risk level. What is raw risk? Amazing, we've got halfway through and nobody's asked a question. That doesn't mean I'm asking for them. Yeah. It's entirely up to you. Okay, we'll close the poll and share the results. And the majority of people went for total inherent risk. So you're listening, which is great. Okay. Let me close the poll or hide the poll and return back to the slides. Now, whether you're dealing with a financial institution or you're doing some form of e-commerce, in all ways, shapes and forms these days, we are sending electronic communications and we're doing interchanges from my computer to yours, from yours to mine. So we'll have a look at what are the emerging standards. We'll take a look at some of the risks, some of the internationally agreed definitions. We'll look at EDI concerns and doing inherent risk assessment, and then looking at control risk and control structure risk assessment. Now this is a slightly different way of doing risk assessment. I'm not suggesting that you use this form of risk assessment for your normal everyday risk. But where you're up into an extremely high risk area, control structure risk assessment can become critical. And you'll see why. Emerging standards. Well, of course, in the US, we've got the NBS as a standards organization. Internationally, we've got the ISO standards, and they use a 7-layer reference model. The ISO 7-layer reference model says in communications, what happens? It's got to go from here to there, it's got to be converted from this to that, it's got to go on that kind of communication, it's got to go to that address, and there's a 7-layer reference model that they use. Now the nice thing about that from an audit perspective is that your systems development life cycle can be reduced because you're following a standardized path, which means that the auditor doesn't have to go and take the thing apart every time. You can look at where the controls are being put to face what kind of risk. You can see the difference between controls over the sender, controls over the network, and controls over the receiver.